Welcome back to the MSCI Eurex Focus Day. So having heard about some of the kind of regional MSCI contracts, we're now going to look at the total return futures markets. Total return futures overall have been one of the most successful examples of futurization we've seen in listed markets over the last decade. And joining me now is a pioneer of the TRF, so Stuart Heath, Equity and Index Product Designer at Eurex. Stuart, welcome to the webcast. I want to go back to the beginning. What was the original launch? So what motivated you and what was behind the original launch of TRFs?
Thank you, Will. Good to be here. So I think if you go back in history, obviously after the GFC swaps had the counterparty risk that was the big focus. So I guess the regulators went down two paths. One, mandate clearing in interest rate and credit, and then on the equity side, it wasn't mandated, but they've sort of pushed towards it by introducing uncleared margin requirements. We were already already had sort of futurized products. So we introduced, div swaps back in 2008. So that was something that had already happened. And we were looking at equity index swaps anyway as part of that process. But what happened with UMR in particular, and I think Puneet mentioned it earlier, is that was the driver, particularly from the bank side. So we started looking at the products around 2014. They went from sort of potentially useful to desirable when UMR kicked in September 16 for the large sell side institutions in particular. So the fact that we launched the original product in December 2016 is definitely not a coincidence. I think secondly is primarily what these products in Europe were initially used for. They were in fact a hedge for repo. They were a repo hedge because the main exposure that the banks hedged between themselves in particular was the risks that came out of the structured product market. And in effect, after you hedge the delta, the banks who are generally, who are structured product issuers are generally short forwards. This effectively makes them long both divs and repo. And these are the two key risks that you have if you sort of hedge the delta. So the way that this was hedged was using total return swaps in the OTC market. I mean, you could use synthetic forwards, but TRS was the instrument of choice. So we introduced this product to effectively replicate the exposures you got from a total return swap, but in a listed, cleared format. So, it was designed to hedge this exposure initially to start with. I guess the other advantage, of course, it was probably a byproduct, was cross-margining. Of course, you can cross-margin these products against equity and equity index products. And the increased distribution capability was kind of a bonus add-on, but it wasn't, the original target benefit of this product. It was repo hedging. So.
Interesting. And in terms of how the pricing works, obviously it's not quite like a traditional future. So can you just talk me through the pricing model?
Yes, I guess by deliberate design, we tried to make this product look and trade and be visible in the order book or traded and negotiated on block exactly as the OTC product the market would expect. So in effect, the buyer of a future is the receiver in swap terminology of the total returns, against which the seller receives an interest rate component, that interest rate component being the benchmark interest rate plus a spread. So that's what the swap market expected. So what we effectively now have is that the negotiated and traded price of a total return future on an index is actually this spread in basis points above that benchmark rate. And that effectively is the price you see on screen and in the trading book.
And how do they clear?
Yeah, so I guess that's possibly the secret sauce of the product, because of course a traded product in basis points is not necessarily the most obvious thing when you go to the clearing system, especially as in times when, for example, there are certain market conditions where this spread can be negative. So if repo is very, very positive, the TRF spread will be negative, and that does not sit very well into a clearing system. So what we did with this product was that we effectively had the Eurex system calculate the value in index points of the prices that traded in the traded book. So when it gets delivered to clearing, it comes to the clearing as an index points product. So effectively it trades like an OTC product, and how the OTC market expects it. It clears like an index future, and how the futures clearing market expects it. So I think that was probably the big crossover, and the algorithms are contained within the Eurex system. So yeah.
And we're going to come on shortly to some of the kind of changes that the sell side needed to make to accommodate the nuances of the product. But in terms of where we are today, how does the TRF open interest compare to similar products at Eurex?
Yeah, so I think obviously the futures market traditionally thinks in traded volume and open interest in terms of number of the contracts. What we need to think of with swaps like products is actually the notional amount or notional open interest that's there in the product. And I think where we've seen particularly for the first product we launched, which was the benchmark Euro Stoxx 50, we've seen an incredible growth in the open interest of this product, and it's probably not that well known a fact that actually the open interest in the Euro Stoxx 50 total return future now slightly exceeds the open interest in notional value terms and contracts of the regular price return future that is obviously one of the largest traded products at Eurex. I think probably what's more interesting is that that these products have actually increased the notional open interest of contracts at Eurex. So what we've actually seen since the introduction in 2016 is, I think, the notional open interest of the Euro Stoxx future that everyone knows and trades and loves and is very liquid was around 100 billion. We're now talking that the TRFs at 106 billion, that the regular futures at 102 billion. So in effect, the open interest has doubled in terms of Eurex, and certainly in terms of these products, and the same is true for some of the other products. I mean, there's somewhere that actually exceeds the regular future. On the FTSE 100 future, for example, that we have, we're already at 50% of the open interest of futures out there in the market. So there's obviously room to grow there. So obviously, I look at liquidity from a notional open interest amount, and that's probably the key driver for that. But it's certainly up there and exceeding now some of the regular futures products.
Interesting. And you mentioned in terms of the clearing, the nuances of the product when it comes to clearing. So, and also the pricing element of it. So, but what changes did the sell side need to make when you first launched and to accommodate the product and process it through their systems?
So I think one of the benefits was that we were actually in very close consultation with the sell side during the development of the product, and I'm pretty sure they had a sort of view to how their systems can cope and handle this. I mean, in the end, it was a sort of almost a design by group for those that got involved. We do know that it was not necessarily trivial to get into the systems. Obviously, there's a few calculations that need to be done, particularly converting from pricing to clearing. That's one of them. I think we found from a front office perspective, it wasn't too bad. That the quant analysts at the banks are pretty adept at putting complex products into their trading system. So there was some development of the front office systems to sort of make sure you have this traded properly, and then obviously there was some mapping in the risk systems because you had a swap, have a future. So that was probably the key thing, and then actually being able to recalculate the prices, to replicate the prices that the Eurex system has and delivers. They obviously wanted to reconcile that to make sure that everything was correct on that basis. Yeah.
Interesting. And I guess for the buy side, as you now see buy side adoption growing, something we'll be talking about shortly. What changes to the buy side, or what kind of challenges should the buy side expect in terms of their systems when they're adopting the product?
So, I mean, as I think Ralph mentioned earlier, we saw an initial change from the buy side to the regular futures product. So it's obvious the buy side, can use swaps or can use futures. I think Poona mentioned, I think there's sometimes a difference between the two desks of who does it, but it's not that it's not available within the institutions themselves. I think there's obviously still a large amount of legacy swaps, however, out there. Why haven't they moved? It's obviously because regular futures are probably not the right thing. So I think in terms of how these come into the systems at some of the buy side, it's probably digital focus of, do I try and put this product into my swap system? Do I treat it like a swap and put it into my swap system with the nuances of the product itself? Obviously it's a standardized swap. It's an exchange listed product, so it's standardized in things like maturity dates, for example. It's the equivalent to a daily resetting product because we don't have unrealized P&L. Or do they try and build it into the futures system, and that can take a bit more configuration? So I think there's some consideration about where it sits. I mean, obviously the institutions can risk manage these properly because they would, traditionally hedge futures or even, equitize with futures. So it shouldn't be a massive task. I mean, however, it could be something very, very simple that needs addressing. So, for example, if an index is at 5,000 and the system receives a trade at plus 50, because that's where the TRF traded at 50 basis points, then you can have a system thinking, hang on, I've just traded at 1% of the value of the contract I had. So there is often some reconciliation done. We know this can sometimes be done manually and obviously then brought into automation over time. But the resources are available. It's just there's a few probably pipes under the floor to connect together. So
yeah. Okay, perfect. And I'm conscious we're up against time, but just in terms of what's coming next for TRFs, what's your growth plan? Where does the market go?
So I think for obviously we've introduced the MSCI TRFs is one of the most recent products we've introduced because we're expanding the product set. As a product developer, I love to expand the product set if I can, but I think it's always based on customer demand. So I always, we've introduced the three main indices because we had feedback of customer demand. I'll let the next panel talk about how that's going to come to fruition. I think for us, we also need to look, we need to try and make the product simpler to trade within our trading systems and simpler to hedge within our trading system. So I think one of the things we'll look at, as well as adding new products, opportunistically, we'll be looking at how we can improve the system so that we can focus, to start with on the market makers, on the liquidity providers, because one of the things that we generally find is that if you're a market maker on a total return future, you want to hedge it. What will you hedge it with? Possibly the regular future. So now how can we make that easier? How can we facilitate that sort of thing? How can we improve the quality of the order book would be a second thing. Now, swaps trade infrequently and in large notional, so we don't envisage this will be an order book product. However, you always check the prices on the screen, so we want to try and make those as good as possible. And if you want to make small adjustments to your portfolio, you don't necessarily want to go and do that, large block trade. You could just, execute in small size on the screen. So I think that's what we'll be looking at for improvement on this. I think some screen liquidity, even if it's not going to be used by the buy side, they'll obviously go to the major dealers to get the liquidity they really want. It still gives them a lot of confidence, to adjust positions in the order book if they want to. So I think we always look at the order book as being a very great sort of support of block trades on the start. And if you look at other products, if you get to a nice balance where there's good order book and still a lot of block trading by the bank liquidity providers, that's the sort of nirvana of where we want to go with these sort of products.
Fantastic. Well, Stuart, thank you ever so much for your time. That was a great introduction to the topic of TRFs. And we now move on to the panel discussion, where I'm joined by Damien Zink, Senior Vice President of Equity and Index Sales at Eurex, and Nir Shah, Delta One Equity Sales Trader at BNP Paribas. Damien, Nir, welcome. Thank you for coming along today. So we just heard Stuart talk about the kind of some of the considerations for the launch, design, and implementation of TRFs. But what, Damien, you first, perhaps, what are the main use cases that you see in the market?
Thank you, Will. As Stuart mentioned initially, for the banks, repo hedging was an important use case. But from the buy side perspective, from the end client perspective, the main use case of TRFs is what we call beta replication. So by beta replication, we mean the possibility to replicate the exposure that you would get from investing directly in the stocks of the underlying index. And since TRFs, as the name suggests, are based on the total return, you will receive indeed, as if you had the stocks in your portfolio, the performance of the stocks in terms of price variation as well as the dividends. So in that sense, TRFs as a beta replication tool can be an alternative to investing directly in the stocks. They can be an alternative to using total return swaps. They can be also an alternative to regular futures, as Stuart alluded to, and or ETFs as well. So that's the first use case. And that's the main one that we see for MSCI TRFs in particular. There is another use case for buy-side clients, which is implied repo trading, which is mainly a use case applicable to or used by hedge funds, which is to take a long and short positions on two different expiries on the same total return future. For example, long December 2024, short December 2025, to take advantage of the spread of implied repo between the two expiries. This is an important use case for other TRFs, such as the Euro Stoxx 50, but we see more of focus on beta replication for MSCI TRFs, because one reason is that the term structure of implied repo for MSCI TRF on average in normal circumstances probably shows fewer opportunities to do these implied repo term structure trading. I would mention also another use case which we could call dividend hedging. It would be in a way a subset of beta replication, but this is the advantage of total return futures in that they hedge the dividend exposure that you may have otherwise if you traded regular futures. That's one pricing component of regular futures, and by this I mean futures on price index, such as Euro Stoxx 50. One element is the implied dividends between now and the expiry. So if you trade regular futures, you take implied dividend risk, which is not the case if you trade total return futures. So in circumstances where there is uncertainty around dividends, or when dividends are volatile, and that was the case, for example, during the COVID crisis, then total return futures are a great tool to get exposure to the index without taking implied dividend risk.
Great, thanks, Damien. Yeah, Neil, what are your thoughts on that? Yeah.
I mean, I think Damien's kind of summed it up pretty well. I think for MSCI TRFs in particular, I think it's going to be predominantly kind of a beta replacement rather than kind of implied repo, because I don't necessarily think there is a curve and a natural slope to the curve like there is for something like Euro Stoxx 50, which kind of is there because of the structured product issuance that comes out in Europe. If we see a pickup in the options market, for example, and you have options traders wanting to trade forwards in order to kind of hedge some of their repo, then potentially at some point we might see kind of more liquidity on tenors further out in the curve, which could then make the kind of implied repo part more interesting. But at the moment, we haven't necessarily seen that. So I think it would be predominantly kind of on the beta replacement side, where I think this product makes more sense.
Interesting. And Neil, what's driving the adoption of TRFs? What do you see from your clients? What are the kind of main pushes towards the market?
Yes, I guess there are a couple of things. I think UMR is always the first reason, where more and more clients have come into scope because of their size and scale, and when they come into scope, they potentially have not favorable margin terms when they're trading OTC products or over-the-counter products such as swaps. So total return futures may make more sense, particularly if they're trading a lot of other kind of listed instruments with Eurex, for example, and then they get the margin benefits. So I think that is one driver. And also, I think traditionally we often find there are a lot of buy-side clients that are unable to trade over-the-counter products in the first place, but have always been interested in wanting to trade products that are kind of OTC-like. And that makes the TRFs quite interesting because, for clients who typically, previously wanted to lock in implied financing levels for a longer duration, previously would not have been able to do that unless they traded a swap on MSCI products, whereas now, because there are these TRFs that are available on kind of your broad MSCI indices, you will find more and more clients are able to do that in a listed format. And a lot of that is often driven by prospectuses and clients not wanting any counterparty exposure, et cetera, et cetera. So I think those are probably the key drivers from my perspective and what we're seeing from clients on in terms of the adoption of TRFs.
That's great. And then in terms of the other products, kind of similar or adjacent products, what's out there similar to TRFs? And we just had a question from the audience as well, saying why trade MSCI TRF against a net total return future? So yeah, similar products there, but also specifically with that relation to the net total return future.
Yeah, sure. I mean, it's a question we have quite a lot because the products are very similar, but there is a slight difference, and that difference is coming from the rates leg. So if an investor was to buy a MSCI net total return future, so the ZWP, for example, on MSCI World on Eurex, embedded in the price of the future is a rates component. And for dealers to hedge that rates component, they're effectively trading an interest rate swap that you have to price into the basis when you get a quote for something like ZWP. And what that effectively means is the end investor is taking some sort of rates risk. And if you are an investor that don't want the rate risk, then the TRF makes more sense because there, when you trade the TRF, you agree the spread, as Stuart mentioned earlier, and the rates leg is compounded on a daily basis using, I think it's the SOFR level for the Eurex contracts. And avoiding that rates risk is something that, is important because for buy-side investors, when they're hedging, and I'm typically speaking to kind of insurance companies where they're hedging their kind of liabilities on the longer dated parts of the curve, they want to hedge their equity exposure and they also want to hedge their rates exposure. And this product allows them to do that efficiently without having to almost do two trades when previously they would have had to hedge their rates exposure if they were trading the net total return future.
Interesting. And in terms of the kind of specific strategies you're seeing, portable alpha, how are firms trading the TRF in that respect?
Yes, I think typically we're seeing two types of flow. The first is, I guess, more on the insurance side, where insurances typically have traded, swaps, and they're generally being on the sell side and selling swaps on things like EFA and MSCI EM on the kind of 1 year, 2 year buckets. They are looking at potentially moving towards TRFs as a listed alternative. And I think the kind of the second part, which is something we're seeing kind of more recently, is the portable alpha side. And this is particularly picked up because in the US, there have been several kind of hedge funds that have been active in the portable alpha strategies and have been growing significant assets. And the idea here is for kind of a hedge fund or asset manager, who are pitching to their end client a MSCI World plus 1% type strategy. And the idea is that they want to track the index, so whether that's MSCI World, EM, EFA, as efficiently as possible. And then use their kind of leverage capacity to generate that additional 1%. And that additional 1% is from a combination of trading fixed income products or trading long-short equity strategies or hedge fund type strategies. And the TRF in particular allows the investor to leverage their index position and then invest in those strategies in an effective and efficient way possible, and minimizing all the different risks. So Damien mentioned the dividend risk. So the TRF is a great instrument particularly on the MSCI side, where you're tracking the net total return versions of a lot of these indices. You're minimizing a lot of the dividend risk, and you're also minimizing the rates risk, as I kind of explained a little bit earlier. So that's why we see good interest from buy side clients for that sort of strategy.
Interesting. And Damien mentioned kind of locking in financing as using the TRFs. Like, how can you just talk us through quickly how that works?
Yeah, sure. So if you were, if buy side client was to come to a BNP or to any other broker or any other dealer and say, can I get a price for, let's say, the DEC 25 MSCI World TRF contract, you'd be quoted a spread, and in that spread, you're effectively, what your kind of financing drift will be versus the SOFR benchmark. So every day, exactly how much you will drift, and that kind of level of certainty is excellent for guys who have portfolio alpha type strategies, for example, because their whole kind of investment thesis and strategy is, how can I beat the benchmark? And in order to beat the benchmark, you need to know how much it's going to cost you with as much certainty as possible to replicate the benchmark. And the ability to kind of lock in financing gives you that good level of certainty. And when you have that certainty, exactly, for example, we've had clients who are looking at fixed income portfolio alpha type strategies, and they just want to know exactly what their drift versus SOFR will be. And when they know that, they can say, okay, what grade of corporate bonds do I need to invest into in order to achieve that level of performance that I'm promising to my investor? And that's quite important. And the TRF is then quite powerful to allow investors to do that. And maybe just one more point, because you can trade at different tenors, you can almost lock that financing in for a shorter or a longer duration. And that kind of is beneficial because there are points within the market, and now is a point where financing is trading relatively rich, and when financing is trading expensive, you want to, if you're on the sell side and you're selling the TRF, you'd want to sell something for a slightly longer duration, and then lock that higher level of financing in, and kind of vice versa. If you're on the long side, you'd want the ability to be able to trade a shorter dated TRF and then lock in something for longer duration as and when levels look more attractive relative to how they've been over time.
Okay, that's great. And I mean, we touched on some of the benefits, but from kind of looking at it from your perspective and your client's perspective, what are the key benefits for them from trading a TRF?
So I think, I guess there are a few. One, it's the listed equivalent to a daily resetting swap, and the fact that it's listed makes a huge difference for a number of clients, because they can cross margin and they can do various other things directly with the exchange. I think also that allows a client to, when you trade an OTC product, you put a swap on with one bank, you then have to, if you wanted to unwind, you unwind with that bank. The advantage of a TRF is you can get kind of best execution on the way in and best execution on the way out, which makes it much more compelling for a lot of buy-side clients because they know they're getting the best price available in the market when they're doing a particular trade. It gives you a lot of certainty on what your kind of drift is versus the benchmark, which for portfolio alpha strategies, for insurance companies that are hedging long-term liabilities, having that level of certainty is very important, and also can have some kind of margin benefits as from a UMR perspective. So I think those are the kind of the key kind of benefits for a client when they're trading TRFs.
Yeah, on the subject of UMR, I mean that's obviously a major factor in it. But what are the kind of core calculations that clients are making when they're evaluating TRFs in the context of UMR?
Yeah, so I think there are a few things. One, if you're a client that's doing a large amount of listed business already, and you're just trading OTC swaps for a few indices, there is a significant impact that it could have if you move everything to listed and have a lot of cross-margining benefits. And we find that particularly the case, for clients trading on Eurex, where Eurex have a suite of MSCI products available, both kind of country level and kind of more broad regional indices as well. So it can make a lot of sense from a offsetting and margin perspective, where you can net some of that margin level down. And bigger scale clients, as they trade with different banks, may have different margin requirements based on the overall business that they have. If you don't have a lot of netting with that particular bank, then you could have higher margin and UMR requirements, and ultimately that is a cost, because with a TRF, with a swap, with any kind of future, you're effectively taking leverage, and when you're taking that leverage, you want to be able to utilize your cash in as efficient and effective a way as possible. So lower your margin requirements, the better it is, because then you can utilize your cash in a more efficient and kind of productive manner.
And Stuart touched earlier on the liquidity, building up the the different elements of the book. But from your perspective, how's liquidity grown, in particular with regards to the MSCI TRFs?
So I think it's interesting, because when we saw the MSCI net total return futures initially come out, it took a little bit of time for liquidity to build on those as well. So similarly, the TRFs are still a relatively new product. I think they're only launched in kind of March or April this year. So I think there's a bit of time that is needed, both from a kind of educational perspective. So I think Stuart raises a good point on ensuring kind of a lot of the buy-side clients have systems that are able to be comfortable with TRFs and value them correctly from an operational perspective. So that's always one kind of hurdle. Again, shouldn't be necessarily a heavy lift. And also, I think the important point to kind of always reiterate to the buy side is liquidity, kind of on-screen and order book liquidity, is very different to what the underlying index liquidity is. And for a lot of these products, the underlying index liquidity, so for MSCI World, EFA, and EM, the underlying indices are very liquid. So investors are able to trade several millions, if not billions, via a block trade, and they can get a good sense of how competitive or how tight the pricing is when they get quotes from various banks, and they have a good indication of how wide the bid offers are. And that easily gives you an indication of how liquid or not liquid that particular market is. So I think it will take a little bit of time for kind of investors to fully understand and assess the product, but I think it will kind of grow over time. And I mean, similarly, the S&P TRFs were launched on CME not too long ago, and liquidity has picked up on those as well. So I expect similar kind of trend on the MSCI products as well.
Great. And in terms of the market evolution with participants, so liquidity is building, the products becoming better understood, people are developing the systems we heard about to be able to trade and clear it. But what do you see in terms of market participants coming in? Are there any trends there that you could point to?
Yeah, sure. So I think there are two almost categories of clients that I think we should almost be focusing on when talking about TRFs. One, it's almost your traditional swap clients, the clients who have traded swaps and will potentially switch to trading a listed instrument. So for them, I think it's less a question of almost understanding the product, but more just do the kind of benefits from trading something listed and having the UMR benefits make sense for them to move away from an OTC to a listed instrument. In a lot of cases, they will. So I think that's one kind of target of clients. And the other target is I think there are several buy-side clients who have historically just been unable to trade OTC instruments. And when they've been unable to, we see a lot of those clients trading ETFs. So there's a large liquidity in a lot of the MSCI ETFs, and also just kind of your traditional futures. And this product kind of allows someone to trade an OTC-like instrument without it being OTC. So I think operationally it can make it very attractive for a lot of these kind of new clients. And particularly, as we kind of touched on a little bit earlier, we're seeing a strong kind of increase in demand from portable alpha strategies. And those, a lot of those strategies are getting large amounts of AUM, and an effective and efficient way for them to track their underlying benchmark is going to be trading something like a TRF in an efficient and an effective way.
Fantastic, thank you, Nir. So, Damien, I want to come back to you now. We talked a lot about the efficiencies that it brings in terms of UMR, but there's also cross-margining efficiencies that are provided at the clearinghouse level. So, can you just talk quickly through how the cross-margining element of the MSCI TRF works?
Yes, the cross-margining benefits occur because we calculate the margin that a client has to pay on their position at a portfolio level, meaning that we look at the net risk that is left when we take into consideration the long and short positions that a client may have. For example, if a client is long MSCI TRF on the IFA index, but is short, let's say, a regular futures contract on MSCI Europe or Eurostoxx 50, there are correlations between those indices, and IFA is to a large degree composed of Europe. Therefore, being long IFA and short Europe or short Eurostoxx 50 is a smaller risk than the sum of the two. And therefore, we would charge margin on the net risk, which will be a much smaller margin than the sum of the margin that we would charge for each position separately. So this means that switching, for example, from a swap to a TRF may result in really a drastic reduction of margin from the client's perspective. And this is on top of what we discussed earlier, which is this punitive initial margin under UMR that you have to pay for swaps. We hear of very high rates of 10, 15%, if not more, whereas for the same position on a total return future, the margin might be just a few percentage points. So that's on top of the cross-margining benefits.
Interesting. And in terms of how firms are trading TRFs alongside regular futures, what are the patterns you see there?
Yeah, we see that it can make sense to trade TRFs and regular futures on the same index. This would be, for example, the case if a client wants to get exposure, let's say, to a notional of 100 million, ideally not tracking the total return index. And that's the case for a portable alpha strategy, as Nir mentioned. They would ideally want to have those 100 million in total return futures to track the price variations and get the dividends and lock in the financing. However, as we discussed, TRFs, a little bit because they are designed to be a substitute to swaps, tend to trade in larger sizes that tend to trade in the block market. And for longer expiries, let's say for 1 year, 2 years or more, they provide exposure, but some clients may want to get the flexibility to trade in and out and reduce slightly or increase their exposure to the index, which they may want to do with a product that is traded more in the order book than a TRF might be. In which case, they could, for example, get 95 million of exposure in a total return future, let's say on MSCI IFA, and trade 5 million in the regular MSCI IFA futures, which will allow them to trade in and out of that position in a more flexible, with smaller sizes, maybe on a daily basis. And that's actually, so that's a suggestion that we make to some clients who want the best of both worlds. And in fact, it's not totally foreign to a lot of our clients who already have swaps next to regular futures. So the idea there would be to replace the swaps with total return futures. So these are cousins in the toolbox, and they can be used efficiently together.
Thank you. And in terms of what's coming next, as you talked about growing the liquidity, growing the ecosystem, but specifically from your standpoint, what's coming next with TRFs?
Yes, I would echo what Stuart said earlier, which is that we think that the trend to move from OTC to listed will continue. So based on this, and also based on specific requests by clients, we may continue to grow the TRF offering. Just to recap again, we started in 2016 with the Euro Stoxx 50, which now we hear has completely taken over the swap market on Euro Stoxx 50. We have the FTSE product, which is also quite successful. We have three other stocks-based TRFs, one on the Euro Stoxx bank sector, on the Select Dividend, which is a niche product, and Stoxx Europe 600. But now with MSCI, we're really going into a more global offering, and we might again expand that offering based on client demand primarily.
Thank you. We are almost up against time, but Neil, it would be remiss of me, considering the excitement we've seen in the markets over the last couple of days since the probably expected but maybe more immediate Trump win than many had thought. What's been the market response? What have you seen from your desk over the last couple of days?
Yeah, sure. So I mean, I guess with respect to the market response, I mean, we were seeing a relatively kind of rich year-end period being priced in. So as investors may know, year-end is often a period where futures and swaps and financing more generally trades quite rich, because banks are trying to optimize their balance sheets, and with positioning very long, particularly in the US. I think the latest CFTC data suggested positioning was, I think, net buy side positioning was net 270 billion long, having been sort of 80 billion long last year. There's a significant year-end premium being priced in, which then means like for example, the S&P December-March roll is trading at something like Fed funds plus 110, 115 basis points. And that has a natural knock-on impact to something like an MSCI World, where 70% of the index is US. So at the moment, we're seeing kind of quite a large year-end premium being priced in. And the interesting point is and what a lot of kind of dealers and buy-side clients look at is, how does the US financing spread compare to the European financing spread in dollar terms? And we've seen that 3-month spread kind of balloon out at the moment to kind of north of 60 basis points, which then means there could be an opportunity for investors to potentially go long European financing and short US financing if they think the financing spread will normalize as we get towards kind of December expiry. So those are the kinds of things that we've been seeing post-election. I think the spot rally we've seen in the US has really kind of propelled US financing levels, and that's having a knock-on impact to something like MSCI World. EM, on the other hand, it's interesting because the Trump administration is going to be very, very kind of pro-tariff, which naturally is probably going to have a negative impact on things like China, which is a big component of indices like MSCI EM. So we could see a bit of kind of a bit of easing of pressure on something like EM, which is, again, had a relatively sustained and decent rally this year. But on the contrary, if we see kind of stimulus on the China side, which there is an expectation that the Chinese government is going to inject some additional stimulus into the economy, then that can have the opposite impact. So I think we're kind of seeing a bit of contrasting flow on EM, where yesterday perhaps we saw a bit of cheapening in EM, while today we've with the expectation that we could see some additional stimulus, we're seeing kind of EM move that a little bit higher again. So I think that's an interesting one to kind of watch out for, where you see almost a balancing act of is Trump is Trump's policies and the expectation of Trump's policies, are they going to be greater and supersede what the Chinese do with respect to the stimulus that they provide?
So interesting times ahead for sure. We are up against time, but Damien, I don't know if you have any final thoughts on the discussion we've had, or you want to give a kind of conclusion to the discussion.
Yeah, thank you. I would really invite our clients, buy-side clients, or the auditors to check with their dealers about MSCI TRFs. Next time they want to renew or extend a swap, because of all the benefits that we talked about. I actually recently met with a pension fund which because of UMR has decided to reduce the number of counterparties that they can trade against to do swaps, and also have limits per counterparty for the swap exposure, and therefore is looking into switching into total return futures as a substitute. So I think that's just an illustration of an institution that is looking into switching to the listed world. So I would invite our clients to inquire to their dealers, and BNP is a great partner for that, and look into the potential benefits of using MSCI TRFs.
Thank you very much, Damien. Thank you, Nir. And that does bring us to a close. We've had a fascinating 2 hours of discussion, covering everything from emerging markets to the futurization of the products. But I think what the key takeaways that I've formed over the last 2 hours have been the opportunity for the buy side to engage now with a whole variety of diverse exposures in a liquid and deep market. So please do take the time to look at a bit more detail at some of the products if you're not already trading them. Please do reach out to your Eurex representative for any more information on what we've been discussing today. But thank you to Eurex for hosting. Thank you to all our panelists, and thank you for listening in. Thank you. Bye-bye.